When you first look at a financial chart, it can seem like just a bunch of chaotic lines going up and down. But what if I told you there's a story hidden in all that noise? Today, we're going to decode that story. We're going to break down pretty much every chart pattern you'll see into just three main groups. And by the end of this, you'll have a much better idea of how to read them. And really, that's the big question, isn't it? Are these ups and downs we see on a chart totally random? Is it all just unpredictable market noise? A chaotic mess of buying and selling that has no rhyme or reason at all? Well, the other way to look at it is that these movements aren't random at all. They are the footprint of a constant battle between the buyers, we call them the bulls, and the sellers, the bears. And because human psychology tends to be pretty predictable, the stories of these battles often repeat themselves, creating these recognizable shapes we call patterns. Now, here's where it gets really interesting. We can take this whole seemingly complex universe of patterns and boil it all down to just three main categories. Once you understand these three groups, the story playing out on the chart becomes a lot easier to follow. Okay, first up, we've got the most dramatic patterns of them all, reversals. I want you to think of these as a giant U-turn on the highway. The market was cruising confidently in one direction, and suddenly it starts signaling a major change of course. So what does that actually mean when you're looking at a chart? Well, if you see a strong uptrend that suddenly starts forming one of these patterns, that's a huge warning sign. It's telling you the momentum is dying and the price might be about to head down. And on the flip side, if you spot one at the very bottom of a long downtrend, it could be that first glimmer of hope that a recovery is just around the corner. Let's look at a couple of classics. Over on the left, you see the double top. It literally forms an M shape. This pattern tells a story. The buyers tried to push the price to a new high, but they failed. Then they gathered their strength and tried one more time, only to fail again. That exhaustion, that's a powerful signal for a reversal down. And on the right, you've got the double bottom, a W shape. It's the exact opposite story. Sellers fail twice to push the price lower, which suggests the buyers are finally about to take control. And here's another very popular pair that works pretty much the same way. On the left is the head and shoulders pattern, with its three peaks. This often shows up right at the top of an uptrend. Its opposite, the inverse head and shoulders, is a perfect mirror image that you'll typically see at the end of a downtrend, hinting that a rally could be coming. So how would you actually trade something like this? Well, first, you've got to identify the neckline. That's the key support level connecting the lows of the pattern, just like you see here. A clean break below that line is your trigger. That's when you'd place an order to sell. For your profit target, a common method is to measure the height of the pattern, from its peak down to the neckline, and then project that same distance downward from the breakout point. And of course, for risk management, you'd place a stop-loss order somewhere in the middle of the formation to protect yourself in case the pattern doesn't play out. All right, on to our second category. If reversals are that dramatic U-turn, then continuation patterns are way more like a quick pit stop in a race. The main trend is just taking a breather, consolidating its energy before it gets back on the road and continues in the same direction. You'll usually spot these when the market just starts moving sideways, almost like it's catching its breath after a big move. This pause, this consolidation, it's just a sign of a temporary stalemate between the buyers and sellers before one side finally wins out and pushes the price further along its original path. A perfect example of this is the rectangle. You can literally see the price just bouncing between two parallel lines, like it's trapped inside a box. In a bullish rectangle, it's expected to break out to the upside and continue the uptrend. In a bearish rectangle, it breaks down to resume the downtrend. Pennants are another classic pit stop. They typically form after a really sharp, strong move. That big move is called the flagpole. Then, the price coils and consolidates into this tiny little triangle which looks like a pennant. The expectation here is for another powerful breakout that continues in the same direction as that flagpole. Trading these is really all about trying to join the trend that's already in motion. For something like a rectangle, you'd place your entry order on the breakout and then target a price move that's about equal to the height of the rectangle itself. But here's the really exciting part about pennants. Your target isn't just the height of that small pennant. Often, traders will target a move equal to the height of the entire flagpole that came before it, which signals a potentially much, much larger move. In either case, your stop loss goes just on the other side of the pattern to help manage your risk. And that brings us to our final and maybe the most interesting category. So far, the patterns we've looked at have given us a pretty clear directional hint. But what happens when the market itself doesn't seem to know where it wants to go? Well, that's when you get a bilateral pattern, a true fork in the road. Exactly. They're called bilateral because the price could break out with force in either direction. I want you to think of them like a coiled spring. The price action gets tighter and tighter and tighter, building up all this energy. They're basically screaming that a big, volatile move is about to happen. You just don't know which way it's going to go. The classic example here is the triangle. Just take a look at this ascending triangle. You've got this flat ceiling of resistance at the top and a rising floor of support coming up from below. You can see how the price is getting squeezed into the corner. That compression builds up enormous pressure. So the question is, will it burst up through the ceiling or will it collapse down through the floor? The pattern itself doesn't tell you which one, but it's yelling that a decision is coming, and it's coming soon. So how in the world do you handle this fork in the road? Well, you prepare for both paths. It's a really clever approach. You can place one entry order just above the formation's resistance line and a second entry order just below its support line. Then you just wait. As soon as one of those orders gets triggered by the breakout, you immediately cancel the other one. This way, you're ready to jump on the move no matter which direction it goes. But, and this is a really big but, there's a crucial word of caution here. You have to watch out for the dreaded false breakout. This is where the price will just poke its head out one side, it triggers your order, and then it whips right back around in the opposite direction. It is a classic trap, and it's exactly why having a well-placed stop loss is absolutely non-negotiable when you're trading these. Okay, so let's just pull it all together real quick. We have reversal patterns, which signal a U-turn. We have continuation patterns, which signal a pit stop. And we have bilateral patterns, which signal a fork in the road. 3 simple categories to help you read the story of the market. So there you have it. That's the basic framework for reading the market story. Now you can start to spot the U-turns, the pit stops, and the forks in the road as they form. The charts are no longer just random noise. They're a narrative that's just waiting for you to interpret it. So the only question left is, how will you read it?